again, we're back to this discussion where talking about labor market weakness and sort of consumer confidence weakness, and a market where desks are talking about blow-off tops going into year-end.
That's right. I mean, I think as market participants, we're counting on the fact that the Fed is going to deliver enough accommodation and quickly enough in order to cushion this process of adjustment that's taking place right now. You know, if they do not only stick with 25 basis points, but do another couple, that's 75 basis points of easing. That means lower interest expenses for a lot of corporations, small and large, and that potentially could cushion, for example, the tariff impacts that corporates are seeing. So I think part of the reason why there's not a whole lot of hiring right now, Carl, going on is because there's just the replacements. There's some churn, there's some replacements, but there's not a whole lot of net new hiring. That's because there's the tariff impact. And if you looked, you know, companies had to absorb a lot of it. They've maintained their margins, but how? They've not actually hired. So if you do have a loosening of kind of financial conditions, that would help.
Did the comment, we covered McMillan's comments from Walmart in the Journal piece the other day about AI and how it's changing the nature of work and the nature of employment growth for a while, like for the next several years. You think that's a seminal comment of sorts?
Look, I was actually thinking about it this morning because the market is sort of, the labor market, I should say, is sort of hanging in the balance right now, meaning, you know, it's not overly weak, but it's certainly not strong. It's sort of a stall speed. But what could push it off the cliff, so to speak? And I do think that needs to be some sort of an external force. For example, artificial intelligence. If it does lead to ongoing layoffs at the time when corporates are already kind of, you know, tightening their belts, you know, that's what could potentially push us over. I think that's something to seriously think about because companies are increasingly experimenting with AI. Now it's 9% of companies, but I think it's happening across different verticals. So I would not be surprised to see some of the job losses be attributed to AI.
Yeah, I mean, first of all, great outfit.
Happy Monday. We're ready for Monday.
I love it. The coordination. We're like twins.
I'm kidding.
So, but what about immigration?
It's a great split screen.
Yeah, look, we were so insane.
I've been speechless the whole time here.
Really?
Well,
I'm glad somebody acknowledged it.
Like my sea double.
We're not calling for the sea of red, just to be sure.
Yeah, exactly. No, what about immigration on jobs? You know, there's this. The immigration supply has changed, right? The immigration policy has changed. And I do wonder if this is just what we can expect now in terms of job growth because we don't have those immigrants.
Well, in a way, we should be somewhat thankful for the lack of additional supply that the labor market has to absorb because clearly there's not enough job creation to absorb that supply. But I will say the break-even rate today is closer to 90,000 jobs created. We're not even creating that much. So I think that's why the Fed actually does need to worry.
Do you think they have to worry about inflation too?
Look, I don't think so. I know there's commentary that, you know, is concerned about inflation, but I think that's a little bit of a backwards look. And what I mean by that, if you look at the core PC inflation, for example, services has been running at 2.5%, and that's been the case for the last year. It's really the goods inflation that continue to push things up. But there's an interesting manufacturing survey a couple of weeks ago that talked about how corporates cannot push through the cost increases to the consumers anymore. So, you know, if you couple that with the weak labor market, I just don't think there's enough of an opportunity to pass those cost increases. So companies may try, but I don't think they'll succeed. So for that reason, I don't worry about it that much. I think it is an issue for potentially sometime into 2026. If the Fed does deliver the accommodation, if they succeed at cushioning the economy, then maybe inflation does perk up in 2026, but I wouldn't say near term.
Finally, just seasonally, got through September okay? Do you think tailwinds start really presenting themselves in October as they normally do?
Well, yes, but I actually think, you know, September defied the seasonal pattern, right? We had a very strong performance for the NASDAQ, for example. So because of that, we're not quite at that same overbought condition as we were in, you know, at the beginning of last week. But I do think we probably need to work off some of that excess enthusiasm first. And once we do, and maybe that's a consolidation, let's say, ahead of the next FOMC meeting. You know, maybe we'll pare back some of those rate cut expectations. But once we work off that sort of excess exuberance, I do think the path is set higher for year end.